Welcome to Chit Chat Money. Today is Tuesday, June 22nd. Today we have an interview with Sleepwell Capital. He's our friend from Twitter. That's kind of how we met. He talks a lot about Spotify, and we're going to dig into audio, basically the whole audio industry. He's really sort of an expert on Spotify as well. And U-Haul, which is another company he's covered. You can check out his Substack. We'll probably link it in the show notes. But post-interview, what are we talking about?
Yeah, so we're going to be talking about, I see you got a fun crypto one. I'll let you maybe explain that. But I got the Wise direct listing coming in London. That should be a fun topic. Huge fintech company going public. And then what else do I have? A list of 1,000 beggars of the last 4 decades. Going to discuss that. And then some of those passive income takes on Twitter, the people that are going to take $50 a month instead of $1 million. We might discuss some of the merits and not of that, so should be fun.
All right, and then I'll be talking about Titan, which there was sort of a big crash this week. It's kind of been all over the news, and a big name was invested, so that'll be kind of interesting. And then the Lordstown Motors Mirage continued. There's been some fallout over the EV SPAC with the CEO stepping down, so I'll talk about that. And then there's some kind of unique anecdotal evidence. I've been on vacation in Cabo, so I've got some anecdotals there. Just
with the real estate agents from The Big Short, right?
Yes, basically. But before we get to our interview with Sleepwell, you want to give our sales pitch for 7 Investing.
Yes, we can. You are going to be listening to this on June 22nd, so that is right before the new month is going to drop. We're kind of almost a week out, and there's going to be 7 new picks. These are highly researched, you get a full researched piece with it, and you get a video call, and you get continuous updates on these research picks. So it's 7 stock picks from 7 different advisors across a variety of different industries. And if you want to check it out, you can use our code CCM and get $10 off your first month. Not much else to say. It's a great service.
There's no reason not to.
There's no way you could go onto this and not find a new stock for your portfolio. There's so much
look back over this is $7 to look back over the entire last year and 2 months if you're just now starting. Plus, it's worth staying with them because they give all those updates.
So whatever style you have, you'll find something for you.
Yeah, certainly. All right. Without further ado, here's our interview.
Welcome to Chit Chat Money. On this show, hosts Ryan Henderson and Brett Schaefer interview industry experts and riff on the world of investing. As a quick reminder, Chit Chat Money is a CCM Media Group podcast. Ryan and Brett are also general partners at Arch Capital, and Arch Capital may have positions in the securities discussed in this podcast. Anything discussed on Chit Chat Money by Ryan or Brett or any other podcast guests is not formal advice or recommendation. Now please enjoy this episode.
Okay, today we are welcomed by Sleepwell Capital. He is a friend from Twitter. We bonded over Spotify. I think we are all shareholders here. So that's kind of how we got to know each other. And then we've been DMing frequently since then. So kind of for starters, how did you get on Twitter, and then why the name Sleepwell?
Yeah, sure. Thanks for having me, guys. And good to get those disclaimers out of the way and not sound, way too bullish on the on the name. But yeah, so I've actually been using Twitter for a pretty long time on the personal side. I think it's back in 2009, I got in it and I had a bunch of friends in there, and just kind of on and off since then, I had been using it. I think maybe 4 years ago or so, I kind of stumbled upon FinTwit as I, became more and more interested in investing. I'd never really used it as as someone who was putting out content from my personal account, but it was enjoying a lot of the content that was out there. Eventually, I realized I had sort of the potential to put out content that people were interested in after kind of testing it out a little bit, but realized I didn't really have the right audience. And obviously, after seeing the popularity of certain anonymous accounts, I remember Bluegrass Capital was a big one back then. I just basically replicated that strategy and made my own account. The way that I came about Sleepwell is, I think it was, just reading a lot about as much as you could about Buffett back when you're trying to learn as much as you can about investing. And obviously most people kind of stumble upon it through him. There was a quote from him back in the 80s where he was talking about Gillette, and he said that he would sleep well at night because he knew that billions of men would grow a beard overnight and sort of wake up to shave, right? So that kind of struck a chord with me. And I don't know, as I kind of started developing my own investment style, it became something that I kept coming back to. And eventually I just decided to choose it as my anonymous account name.
Yeah, and it seems it's the anonymous Twitter account. It seems like a unique existence, but there are some advantages. You can really just, speak your mind.
Yeah, exactly. It's kind of odd. And I mean, when I started, and I really only started in January, I remember I was kind of testing it out because you never know who you're really talking to. And it's weird when you don't have that many followers in the beginning. And I remember Value Terminal, who's a friend on Twitter as well. I think she tweeted out something like, if you have less than 1,000 followers, like tell us something about yourself and we'll give you a hand. And that was like my first bump. I put something in there and I got like 200 followers in a couple of days. And I was impressed by that. And, you kind of, you just kind of go and I think finding your voice is really important, but it does have its advantages to kind of just forget that the fact that people don't know who you are, how old you are, what your background is. It's very meritocratic in that sense, right?
Right. Yeah, that makes sense. All right, and then back to your investing style. So how would you describe it? Like, are you, value, growth, or just whatever? And then how do you manage your personal portfolio?
Yeah, so I think the best way to describe my style is first, it's two parts. It's always evolving, right? Because I guess I've been investing more seriously for the last kind of 8 years, but it's always changing, especially when you're getting started. You got to find what works best. I think right now I call myself kind of long-term concentrated quality. That's what I've been migrating to kind of more recently. I started out in the traditional kind of value investing camp and trying to buy companies at 6 times earnings, hoping that they get up to 9 or 10 times earnings and then selling them. But pretty quickly realized that those companies tend to be lower quality and they can stay at those multiples for really long times or even go down because the earnings are going down. So they just naturally get more expensive as you hold them. And it's just, you have a lot of headwinds going against you. And, sort of that way I came about more higher quality companies and learning about, obviously Buffett's transition into more quality, but then more recent investors that have focused a lot on not only that, but holding companies through the very long term, right? And for me, I guess long term is really 5 to 10 years, is because everyone kind of has their own definition. But yeah, I mean, another part of my life that I think influenced a lot of my investment style was I spent a few years working in fixed income. So, working in credit helps you think about companies in a different ways, because you always get to them and you start off with the question of kind of what can go wrong here, right? Because your upside is you get paid and you get, you get paid back your principal plus your interest, but your downside is the company stops paying you and you probably lose 70%, right? Depending on what the recovery is. But it's really just a very useful additional tool for equities investors to be able to understand the other side of the balance sheet. And I know if you look at my portfolio, you'll see some names that maybe you don't traditionally associate with like high quality, but I became pretty comfortable with them after having looked at their bonds, for example. So as soon as I became comfortable with the liability side and these were trading at pretty low multiples and I thought the earnings would grow, I thought, it made sense to buy the equity.
Yeah, it's interesting. It's kind of like, I feel like most individual investors kind of overlook the fixed income side, but it seems like it could tell you a lot about a business and sort of the quality of it.
Yeah.
What about, you want to talk audio?
Yeah, do we want to get into it now? I think that's what everyone's waiting for.
Yeah.
I'll kick it off with the first question. It's going to be on, we're going to hit Spotify, but we're going to really hit live audio in general, kind of look at those dynamics because that's a really fast growing industry right now. And then we're going to talk a little bit about UMG, the label that is getting spun off and going public. But first question, what's the live audio opportunity for Spotify? And then how are they positioned versus other competitors like Clubhouse and Twitter, and I guess Facebook's getting into the game as well?
Yeah, and I mean, my sense is we're going to keep seeing more and more of the big tech people, trying to get a piece of that. I think first, it's important to, kind of set the ground straight on a couple of things. Live audio is a huge opportunity, right? And there's also the fact that it's really a completely new market, right? There's no comparison to it besides looking, at radio, which I like to think as radio as kind of the last domino to fall from the legacy media that hasn't really been struck as much from the internet, right? There's literally billions of people that still listen to radio every day. And I think with some of the, kind of recent trends that we've seen in the last couple of months, including Clubhouse as really one of the major drivers, because that's kind of when really people started waking up to it. I think it's going to be, again, it's going to be an evolving market where, monetization is not as clear yet, but my sense is it's probably much bigger than people think. And that probably means there's also, a decent amount of share for some of these companies to take. It's not necessarily going to be a winner take all market in my sense, because think about all the different formats and content and sort of categories that there are out there. I like to give the example of Twitter Spaces a lot because, especially us that spend a lot of time on it, we're sometimes, I think, a little biased to Spaces because it works so perfectly well for FinTwit, right? Like, it's a very engaged audience that's super interested in learning, and you have, so many experts that it's just so easy. Whenever one of them starts talking about a subject, it's just really easy to drive the audience that you already have over there, right? But that's just one niche, right? So, if we turn to Spotify, they bought Locker Room, right, 3 months ago, which was a very sports-oriented kind of Clubhouse competitor. This last week, they rebranded it and relaunched it as a Spotify Green Room. Now, Spotify has a couple things going for them in live audio, right? I think first, the user base is massive, right? It's over 350 million monthly actives and it's a highly engaged user base as well, right? So that's important. But I think you have to also think about the supply side, because where's the content going to come from? Spotify already has very strong and existing relationships with basically every artist in the world, right? Every artist in the world really counts for Spotify as their main, or at least not main, but one of their biggest sources of streaming income, right? So you have that as a very natural fit for, call it live online concerts or a listening party or a Q&A with your favorite artist. So that's a very big advantage in my opinion. But then if you think about the podcasting side, you not only have, existing podcasters like yourselves, where if you already have a big audience in Spotify, it's only going to be natural to sort of go there to engage even more with them. But you also have exclusives, right? So, Joe Rogan and, hosting a Q&A on Green Room and selling tickets for it. There's a lot of things you can sort of experiment with. And this exclusive roster has only just kept growing, right? I think the bigger challenge for this industry that a lot of people have talked about is the discovery aspect, right? Because the problem with live audio is that, well, obviously most of the time it's not recorded, right? So you only you can only listen to what's happening at the right exact moment, and it has to match your interest, right? So Spotify is at a great advantage in that sense because of that supply and demand dynamic that I talked about, but also because of their focus on using data to really drive that discovery, which they've been arguably been able to do pretty successfully on the music side, right? I think people would probably agree on that side. So I think that's what they're going to try to do both in live and in podcasting.
Right now, Green Room is its own app, right?
Yeah, that's correct. It's basically Locker Room rebranded. Like it's not like, let's be clear, it has a lot of improvements to go. Like it's not a good app right now, but knowing how fast Spotify has innovated their products over the years and the sort of management tracks record there, I would expect a lot of changes coming in the next couple months. I mean, we've seen it with podcasting, right? And I think that's another important point to make, that is a challenge for other companies, especially when I see companies like Facebook trying to get into audio. Consumer habits are super hard to change, right? We all know that, and I think one advantage that Spotify has going for them is that everyone who uses Spotify thinks of Spotify as an audio app, right? Like you don't have to really change their habits for people that are listening to music to change over to podcasts. There was some habit changing that took place there, of course, but it wasn't as much as you would, telling people to listen to audio in Instagram or Facebook, where the use case is very different. And I think it speaks a lot to this fact that they were able to basically become the number one podcast player in a matter of 3 years, right? So I don't see why something similar doesn't play to their advantage in the live audio space, right?
Yeah. And then two other things I think Spotify has for their advantage is they own a ton of studios, right? So you could have Bill Simmons going on weekly, or I don't know what the cadence would be. He could go on Spotify Green Room. You get the Gimlet people. I forget all the other ones that they own.
Yeah, it's Parcast, Gimlet. It's a lot. Yeah, you're right. I mean, they're definitely gonna leverage that. I think another kind of interesting question is because Ryan, you were talking about that the fact that it's a separate app. Like I'm not sure if it's going to make sense to integrate that fully into Spotify eventually. I think it's also going to be sort of a testing phase to see if it makes sense to keep it separate or not. I think there's a point where you're putting way too much stuff in an app, and maybe it's detrimental to the engagement. But again, I sort of leave that to management, right? And that's where you sort of have to trust them in their execution.
That is, I mean, we talked about this just before the show. Is there's so much going on now with, I guess you could call it optionality, that it's like, does that make the platform messy or difficult to navigate from the consumer side? Yeah. What do you think there?
In terms of, optionality in the app or how?
Yeah, I mean, you could add in live audio. You could do podcast discovery, which we're going to briefly talk about here with the new pods integration potentially.
Audiobooks too.
Audiobooks, all that stuff. Do you think there's any point when it's like, all right, that's too much for the listener or for a user?
Yeah, I mean, it definitely could get to that, and that's kind of the point I was trying to make with maybe it makes sense to keep live as a separate app, because there's a point where you're kind of putting way too many features in one specific app that they sort of lose value for the customers and get lost, and it's definitely a risk and something to consider.
Yeah, and I think even with podcasts, I know that it's great to have the interoperability. But if they allowed people to have the option of maybe doing Spotify music only, Spotify podcast only, or you can have it together if you want, a lot of people would enjoy that, because there's some people that just do music. They don't want that podcast stuff crowding up their feed. I don't know if that goes against like their the benefits of that, but we'll see.
Yeah, that's an interesting one as well. And I've definitely seen, kind of segregated cases of people that have criticized that the combination, but so far from the data we've seen, it makes sense to have them together for now. And I do know kind of management thinks they want users to wake up and just like press play and just use Spotify as their only audio app for the entire day and just kind of pause along the way, but come back, So it'll be interesting. There's definitely a lot more to come, and we're still in the very early stages of this.
What do you think of the new Pods acquisition? I think this closed, or I don't know if it's even closed, but they announced it last week. I guess then bigger question, what do you think of the podcast related acquisitions that they've made in the past so far, just generally? Yeah. So I think it's very interesting, and it's definitely the kinds of acquisitions that I want to see and that have historically worked for a company like Spotify, because essentially what they're buying here is supposed to be one of the best podcast discovery tools, right? And it's interesting because Packy actually wrote a pretty good piece about this, I think it was like 6 months ago or something, and he suggested that Pods should partner with Spotify on this. So it's pretty funny that they ended up buying him. But he talks about the power of this Pods platform as being able to sort of using machine learning pick and choose the best 30-second or 1 minute clips of any specific podcast. And apparently it's really impressive what they're able to do. So as if they can leverage this in some way to help their podcast discovery and another kind of problem with podcasts that some people talk about is that they never go viral. Like you usually just see them on Twitter or have a friend send it to you, but you've never really seen a podcast go viral. I mean, the only thing that comes to mind is Elon Musk smoking weed in Joe Rogan, but that was really like a visual kind of video, right? Almost like a TikTok thing. But I think that makes a lot of sense. It's interesting because Spotify used to make a lot of acquisitions on the sort of algorithmic music discovery space, and one of the companies that they bought was called the Echo Nest, which eventually put in sort of the foundation for Discover Weekly, and that's really when personalized music took off, because people were just amazed at the quality of the songs that were being picked, and it wasn't just songs. It wasn't actually songs you knew. It was songs that you probably had never heard before, which made it all that more impressive, right? So I like to think of this acquisition as a signal that they're trying to do something similar with podcasting. And if they are able to take up a big step forward on that side, as we've talked about, it's going to be huge, right? I think actually discovery is one of the main, in music is one of their main sort of competitive advantages that I think is pretty misunderstood. We can talk a little bit about that later, but just, continuing on with the other topic that you guys asked about specific to their podcast acquisitions, that's probably the most similar aspect that Spotify has to Netflix right now. It's interesting because I think it's very instructive to actually study Netflix when just learning about business in general, but also when thinking about Spotify. And I don't like to think of them as equals, but it's still, you can definitely see a lot of similarities along the way, right? Because they started out, renting out DVDs. They basically saw the writing on the wall and said all videos are going to, and movies and TV shows are going to go to the internet. Like, we have to do something about this. So they transitioned to streaming. And then after going through that transition, they realized they needed to own their own content. So it's kind of similar to what Spotify has gone through, right? Because they started out in music, actually had a couple of setbacks along the way when the consumer was transitioning from the desktop to the mobile phone, and they were able to survive that. But then they kind of realized, this market is much bigger, and we can
music is definitely a tough business to be in, at least at that specific time with lower gross margins. So they decided to go after all of audio, which meant podcasting, and now they're basically following that Netflix playbook by buying all these exclusives and licensing all these different big names that we've all heard about. Are all of them gonna work out? Probably not. But I mean, again, it speaks to their scale advantage, because they can afford to pay more while at the same time pay less, right? And Ben Thompson has talked a lot about this over the years, and when analyzing Netflix. And I mean, I ran some quick numbers at a couple last week with like Call Her Daddy, right? They're paying $20 million a year. Basically means you need to monetize 1.7 million users at $1 per month, right? Now, she has anywhere from 3 to 4 monthly listeners, 3 to 4 million, right? She has almost 2 million followers in Instagram, and Spotify has, 355 monthly active users. So it's not a stretch to think that you can surpass those numbers. And that doesn't even incorporate, things like we were talking about live. Like, what if she does a show, a special show in live and sells tickets to it? Well, what if she sells subscriptions? I'm pretty sure she's going to do some sort of advertising in partnership with Spotify, who's going to have, the best probably advertising technology and the targeting tools to be able to monetize that better. So, it's going to take some time to see the impact in terms of the benefits to the business, but I think it's working out. I mean, if you look at the top 5 podcasts right now on Spotify, 3 of them are owned by Spotify or exclusive to them.
Right. And internally here, we discuss, all right, all these acquisitions seem smart. Things seem to be moving in the right direction, but does the ad network, is that really the crucial point? They have to get that right in order to make this, all these acquisitions make sense from a financial standpoint.
I think advertising is a very big part of the opportunity. The big problem with advertising in podcasting is that it's so hard to track, and it's so hard to sort of dynamically insert targeted ads, as I'm sure you guys know. And this goes back to just kind of the really old technology that podcasts is based off, right? The rails are all RSS, and all that RSS will tell you, and Apple Podcasts is built on this, for example. All they will tell you is how many downloads you get, right? You don't get any sort of additional statistics in terms of listenership and kind of, like if they skipped over the ads or if they even listened to the episode. So that's a very big reason why Spotify decided to not go with the RSS technology and just use their own streaming technology, and now they can track all these statistics much better. The next step, as you mentioned, is kind of going after the advertising by aggregating all the content, and that's both on the podcasting side as well as the ad inventory from whatever brands would want to advertise there. And if the real opportunity is that if it's really solved and becomes a much more effective advertising means, it's going to monetize at a much higher rate, right? I think advertising monetizes at, I think globally it's probably around 30 to 40 cents per user per month. And
just to interject, we work with Megaphone, and they mentioned that on average right now, and to be clear to the listeners, Megaphone is owned by Spotify. Yeah. Their average CPM is $26, so 26 cents.
Yeah, exactly. So, okay. So that's, and I think in the US it's a little bit higher, but,
right.
But, if you look at, I think Pandora is around 160, and they've actually used dynamic sort of ad insertion for a little while now. So that's kind of an instructive comparison. But yeah, I mean, if they're able to, it's not only about exclusives, because obviously exclusives are a big part of engaging your existing audience and bringing in new users, et cetera. But if they're able to, aggregate all these content creators and have them spend more time on the platform because it monetizes at a higher rate, and I mean, you guys are a pretty good example. I'd love to get your take on it as well, but it could be such a large market. And I mean, radio is I think 35 billion globally, but I'd say take that with a grain of salt when you're comparing the podcasting opportunity versus radio, because look at what happened if you compared Google to the newspaper total addressable market. Like, you were off by magnitudes, right? And that's what happens when your audience is much more global, and you can probably monetize much more effectively, right? So how do you guys think about that? I'd love to hear your thoughts, given you guys are on the other side.
Yeah, Ryan, you want to go first? Yeah.
Yeah, the efficacy thing, like, it's huge. And not only, I mean, Spotify kind of has the advantage because they have so much listener data, and we don't always know what ads are run on our shows because it's specific to the listener. But yeah, I mean, just from not only as a host, but as a listener, I always find podcast ads, when they can put like their own personal touch on it, more effective. I think like the one I think of is the Barstool Cash App relationship.
Yeah.
It just worked. I'm not sure. And maybe it's hard to track what goes on behind the scenes because maybe you don't click a link or something like that. But yeah, it feels far more effective than a radio ad.
Yeah. And then to add on to that, from a show, we want people to listen on Spotify because the ads work better than there, or at least that's a little bit anecdotal, but that's what we'd assume. And then from the analytics standpoint, if you use the Spotify for podcasters, I think that's what their analytics tool that we use is called. You can see how many people stream it or start a stream, and you can see how many people listen to more than a minute. And then you can see how many people are falling off at certain points. So we've seen, like, for certain things, okay, we want to move something, we lost 20% of our listeners at this segment. Okay, this segment's not doing very well. It really helps us out in crafting the show. And they're a lot more helpful than Apple, which is just honestly hurtful, where they change their update and you lose like 10% of your listeners overnight or something like that. You get no analytics. It's a whole black box.
Yeah. To any listeners listening right now, please stop skipping through those ads halfway through.
And then one thing on the
little dip.
Out of Apple, a lot of the Apple listens, and we've talked about this with Francisco, who is very knowledgeable about Spotify as well. Yep. We believe and I think a lot of people know this, a lot of the Apple downloads are not listens, because we get a ton on Apple.
They're automatic.
That automatic, right? We drop the show at 1 a.m. Eastern time, and we get a ton of downloads right then. But that doesn't make any sense. You have no idea who's actually listening.
Yeah, exactly.
Yeah.
That's well. Let's pivot to Universal a little bit, because that's something we want to get your takes on. So I guess just the deal, I believe, just closed. So what are your thoughts on the valuation of the deal? What do you think of UMG?
We don't have to go through the 10 different steps of the Pershing Square, the most complicated deal of all time.
Oh, no. Yeah, absolutely not. And just to be clear, I've been looking at it, very pretty much like on a high level. Like I haven't done a deep dive or anything, but, broad strokes, I'd say it's valuation looks interesting to me. And one thing to kind of get out of the way is that I'm very bullish on the music industry as a whole, in terms of, sort of the revenue pie growing a lot and monetization getting better, and kind of, if you look at music and compare it to other media like video games and TV and movies, it's the difference is incredible. I think it's something to the order of four to five times smaller, right? So my sense is that's gonna close in over time, not completely, but just close the gap, right? So in terms of UMG specifically, the biggest growth driver is streaming, right? And really their transition to digital. It's about 2/3 of their revenues right now, with the remaining 1/3 being basically physical sales and things like merchandising. And it's pretty realistic to see a scenario where the revenue grows at 10% plus over the next 5 years, and the margins go from, I think they were just below 18% last year, and probably going to surpass 22, 23 in the next 5 years or so. So if you kind of play around with those numbers, and that's usually how I try to think about valuation. I prefer to use easy math and just make the assumptions easy. I could see this returning like a 14-15% IRR over the next 5 years, which is basically a double from here. They paid, I think it's 23 times EBIT, next year's EBIT or something like that. But again, just thinking where the company could be in the next 5 years, which is usually how I try to think about how to value a company, because again, it just goes back to my long-term thinking. And it's it looks like a pretty decent bet. I mean, they have a lot of things going for them.
Yeah.
How do you think about their relationship with the streaming providers? So Spotify and UMG, do you think there's any scenario where Spotify has so much leverage that it starts to hurt Universal?
Yeah, I think at least in the next, in the medium term, call it, I don't think that's gonna hurt them too much, or even happen, right? Like Spotify making a very big move in terms of magnitude of like starting to sign all these superstars or anything. The label business is a very complex business, and there's a reason why the top 10 artists are signed with a label, right? It's not only because they provide the money. It's a very complex kind of marketing and logistics and sort of networking kind of business, right? But going back to that question, I think this is a supplier customer relationship, right? And I like to think of it as very symbiotic, right? It's going to be profitable for both. Obviously, these negotiations that take place every 2 to 3 years are, they're pretty complex, but Universal and all the labels are as profitable as they've ever been, and in large part it's thanks to Spotify, and Spotify hasn't really captured the value or achieved the margins that arguably it deserves, given the value that it has added to the industry and the whole ecosystem. So I think they're going to get creative in finding ways to make it profitable for both without necessarily hurting each other. And there's many things they can do for to accomplish this. We've already seen the announcement of the two-sided marketplace, which basically means that Universal is going to be spending some marketing dollars on Spotify's platform. So that basically brings 85% margin revenue to Spotify's P&L, while at the same time it's just moving around the marketing budget in Universal. It's probably going to take some time because, again, these labels are very big and old corporations, and they're not known to kind of use a new technology in sort of in a broad way, right? They sort of have to get used to it first. But the other part that I think they can play around with is the price increases, right? They've both talked about it. Spotify has started announcing price increases in actually a couple markets, and it's a very interesting way to kind of effectively increase Spotify's margins without optically seeming like they're paying less to the labels. Because if you think about, they pay around, call it 2/3 of their revenues out to rights holders, right? So it's not all to the labels, but it's to the rights holders. And if they agree that for every incremental dollar, Spotify is going to get 50%, it's instead of the 30, instead of that 35 or whatever, the labels are going to get more and Spotify is going to get more, right? So it comes back to that comment I was saying about closing that gap. And I know the labels are very enthusiastic about that as well, and they talk about it in all their filings about the pricing power and all that, and that's going to be a very interesting route. I think the bare thesis about the labels, kind of pulling catalog has been completely,
they can't.
it's practically impossible by now. Like, and I've talked about this on Twitter multiple times, but basically it would be you're losing 20% of your highest margin revenue, and you have to deal with shareholders, deal with management that's not going to reach their incentive targets. You have to deal with all the artists and songwriters that stop getting paid. Like, it just doesn't make any sense. Like, for what reason? They're not going to go exclusive. Like, everyone knows exclusive music doesn't work.
Yeah. Yeah. Outside of the streaming services, it's pretty easy to see the steady growth there. How does it work with, YouTube, TikTok, even Roblox is, I guess, a new partner. How does that work? How do the licensing deals get done on that? Yeah. So,
at least in the example of TikTok, where it's a large part of the platform is kind of based off of music.
Yeah.
It's tough because I think what the labels try to get to is capture some of the value that's being kind of generated by this platform thanks to music. And with TikTok, I'm guessing those negotiations were pretty complex. But essentially what they end up doing is they take a cut of the revenues. In the case of TikTok, it's going to be the advertising revenues that TikTok makes. But of course, TikTok is going to argue, music is only a part of it. Like, it's our algorithm, it's our, it's the videos that people are posting, et cetera. So they probably end up paying obviously much lower than payout than Spotify in a percentage basis as well as in an absolute basis. I think it's Peloton that pays out. I could definitely be wrong on this, but it's a number like 20% plus of the revenues, if I recall correctly. It's not insignificant, right? But I mean that's the labels. It's the labels' job, right? It's they have to monetize as much as they can and sort of try to make the case that music is being used in a way that they should be sharing part of that revenue with them. And I mean, they have to pay them something always, because it's illegal to use music without a license in a place like TikTok and YouTube and Roblox, etc. But yeah, there's not a lot of transparency in these deals, and you're never gonna get like the exact details of it because they're super confidential. But we kind of know how they work, right?
Right. And with, I guess, Spotify in general, flipping to their viewpoint, is there any way for them to negotiate the revenue share lower if podcasts become a better part? I know they have to go back to like the drawing board and renegotiate stuff, but do you think that's going to give them some leverage to maybe get it down to 60% payout or something like that instead of 2%?
Yeah, I wouldn't expect that, and I'm not really counting on that. Like, it's not impossible, especially if podcasting becomes a huge part of the business and they struggle to monetize it correctly. I think they could probably go back and try something like that, but it's definitely not like my base case. And what's interesting is so Spotify is two businesses, right? Basically, it's the ad supported and the subscription business. On the subscription business, everything goes to the labels, no matter how many podcasts you're listening to. The way the agreements work is that all that revenue share is for the labels. What they were able to do so far is separate the advertising. So any advertising, obviously, that takes place in a podcast is going to be separated to podcasting and the creators and have a different margin profile. What I think is going to be what I think they're going to be able to do is just to incrementally monetize the podcasting side. And that goes back to what we were talking about advertising. And they've also talked about a premium subscription service for special, for podcasts, right? And I mean, you guys, I don't know if you've heard anything about this, but you eventually will be able to sort of charge $5 per month and have bonus episodes and maybe even like a Q&A and green room and stuff like that with your premium subscribers. And most of that's how I like to think about their potential opportunity, is just incremental revenue that's going to sit on top of the existing revenue base that they have.
Right. No, yeah, we've heard of that. It's still slow to being rolled out, but it's definitely a great way to experiment.
But in general, I'll say the podcasting strategy, and people forget about this sometimes, but it will help them a lot in the negotiations going forward. And again, these contracts are not only about the payouts. There's a lot more to them in terms of what Spotify can do and business initiatives. Like we know that the labels at some point had to approve like acquisitions that Spotify was doing, et cetera. So if you go back to the negotiating table and 50% of your users are listening to podcasts, and just call it 2/3 music, 1/3 podcast, it's going to be a different conversation than if you were still 100% music, right? I mean, the labels is going to essentially have their listening share diluted, right? So I think it's going to be interesting.
Last question before we hit an ad break and then move on to U-Haul.
Yep.
What do you think of a TikTok competitor as a threat to Spotify?
Yeah, competition is interesting and definitely very like important to keep an eye on. I think TikTok as it is in no way a competitor. I mean, it's a music discovery tool if anything, and it's almost accidental. Like people don't go to TikTok just to listen to music. I mean, at the end of the day, I forget if they're 15 or 30-second clips, but yes, it helps. It can help an artist kind of blow up, but eventually they just go to Spotify to actually listen to the songs. What I think is more interesting is their ambition to also build their own music streaming platform, because they have announced that. I think it's called Reso, and I think it's launched in only a handful of markets, and we haven't really heard much updates on that side. But the fact that TikTok is obviously has very powerful technology and it's a large financial backer and large valuation, so they can raise tons of capital at pretty decent terms. So if they really wanted to go after, I think it's definitely something to keep an eye on. I think the other kind of competitor that I think about a little bit is YouTube, even more than Apple and Amazon, where I'd argue their music is merely a distraction for them. And I mean, there's a lot of evidence to that, but with YouTube, I mean, there's over 2 billion people that use YouTube, right? And a lot of them listen to music. The problem is I haven't seen them really take audio seriously, right? If they really shifted their strategy towards like audio and started giving out more, giving out the product for free and really innovating on that front, I think they could be a pretty compelling competitor to Spotify. I just haven't seen any evidence of them sort of shifting their strategy, and it's probably going to stay that way because video is much higher margin and it would probably disrupt their own business, et cetera. So,
yeah. All right. Well, we're going to hit a quick break and then we'll talk U-Haul on the second half.
This episode is brought to you by HP Instant Ink. No one is reading your mind, but HP Instant Ink knows when your printer is running low and sends you new cartridges, so you never have to think about ink. Save up to 50%. You'll pay less than $5 a month for ink and never run out again. Find out if your printer is eligible and enroll today at hpinstantink.com. Conditions apply. For details, visit hp.com/instantink Spotify.
Support for this podcast comes from Invent Together. According to studies, less than 13% of all inventors who hold a U.S. patent are women. Black and Hispanic college graduates patent at half the rate of their white counterparts. But we can fix that by increasing participation in innovation and patenting by underrepresented groups. It would quadruple the number of American inventors and increase annual GDP by almost $1 trillion. Invent Together is a coalition of organizations, companies, universities, and concerned citizens committed to ensuring that everyone has the opportunity to invent and patent. Because the more diverse the American patent system gets, the stronger and more successful our nation will become. What can you do to help diverse inventors patent and unleash economic opportunity? Find out at inventtogether.org. Learn more and take action today.
Welcome back in. Next up, this is a company that we haven't looked at much, but you've covered them, and it's U-Haul. Probably something anybody that's moved is familiar with. So just generally, what's kind of the thesis there for you? Yeah,
sure. So, when I invest, one of the first things I like to do is just really understand the 2 or 3 drivers that are going to drive, the majority of the company's value going forward. And in the case of U-Haul, you have to believe basically 3 things. The first is that they're gonna keep being the indisputable leader in what is called the do-it-yourself moving space, which obviously is just going out and renting out a truck and moving yourself, right? And they've historically, they've been around for 75 years, and they've historically kept taking market share every single year, right? More recently, the past call it 10 years, they've been growing at high single digits. The second kind of premise that you have to focus on is their expansion into self-storage. Okay, so U-Haul basically 20 years ago realized that self-storage was super complementary to their business, because obviously people that are moving, a lot of them tend to have, storage needs. So it just became kind of low-hanging fruit to combine those two and build storage units close to the U-Haul locations. And they've been expanding that for the better part of the last 20 years, and are actually now the second or third biggest self-storage player in the US, which is pretty impressive, and a lot of people don't realize that. And the third aspect is management, because this is a company that is, for all intents and purposes, a family-owned company that's controlled, right? The founders own over 40% of the company, so you really have to be, on their side and trust all the decisions that they're making, because how they treat shareholders and their capital allocation priorities, et cetera, are super important for the business going forward. So I think those are the 3 kind of things that I like to think about in terms of U-Haul as an investment going forward.
Right. And then getting deeper, when you look at U-Haul, you're like, well, this business probably has, a moat or competitive advantage, because when you think of moving, you're like, well, I'm just going to get a U-Haul. But could you go maybe deeper on why they have a moat and what they've invested in that gives them some sort of competitive advantage?
Yeah, absolutely. So the most important part is realizing that in this business, scale is a huge advantage, right? And scale also means you eventually reach a point where you have physical network effects that kick in and are super powerful, because you guys are in Seattle, right? If you want to move to, I don't know, some random town in Ohio, you want to be able to find the cheapest option, but also kind of, if you're going to do it yourself, you're going to be able to rent out from a place that's close to your house, the one that you're living in, but also a place that's close to the house that you're moving to, right? So if you look at locations of U-Haul versus competitors, they have 10 times more locations than the next closest competitor, which is Budget. And if you look at the amount of trucks that they have 25 times more than Budget, right? So it's a huge difference in terms of size, and it's pretty quickly you realize that the majority of the time they're going to have the most convenient option for anyone to move. Whether that be, in town or out of town. Obviously in town is more competitive because you're only moving, maybe a 10-minute drive or whatever, but it's proven out to be that it's super important to have that scale. And if you look at, Budget and even Penske and Ryder, which are the other 2 kind of big truck leasing companies, they've both retrenched. Budget has gone through multiple restructurings the past 10 years and has reduced their fleet. And Penske and Ryder basically turned to B2B. right? They only focus on the commercial side right now. So, everything points to the fact that this is a real competitive advantage. Now, it's not. I'll be clear on this part. U-Haul's not a great business. Okay, it's a good business, right? And what I mean by that is that if you look at the returns on invested capital, it's probably around 11 to 12%, right? So nothing sensational, right? A great business would probably be closer to 20 or even more than that. But what makes me very comfortable is the fact that the competition, as I said, is very limited, and this sort of gives you much better kind of long-term visibility for the business going forward, and you can make a good amount of money on businesses like this, especially with a company like U-Haul that's investing all of their capital back into the business and has some leverage. So I think that's another kind of, some people focus too much on like ROIC and like only screen for companies that are above a certain level and stuff. But I think if anything, U-Haul's ROIC is going to go up, and one of the best ways to make money in the stock market is to kind of invest in a company right before its ROIC inflects upwards, right? You can make a lot of money that way.
Right. Go ahead, Ryan.
I don't know if you have the numbers in front of you, but what kind of valuation does it trade at? Do you know?
Yeah, it's around 10 billion right now. So the way that it's hard to think about U-Haul in terms of, you have to make a lot of adjustments, right, to the income statement, and management doesn't provide any sort of guidance or even adjusted earnings, which most companies do. They'll just tell you the GAAP earnings, and you have to kind of go your way.
I was reading the conference call. The analysts are mad every time. I don't know if you read the conference calls, but the analysts get mad. They're like, "Are you going to do something?" And they're like, "Nah."
No, they do.
Yeah,
they do, and that's why I stressed that management is so important, because this is not a company to hold for 2 or 3 years. Like, you really have to be up with them on the long term, because that's the way that they operate and think. But going back to the valuation, so on a per share basis, I think the company probably will make this year around $40 per share. So that's around 13 times at the current valuation. There's a couple of things you have to consider going forward, right? The first is that self-storage, the way that they've expanded to self-storage, especially in recent years, is not by buying properties, like existing properties, because management has been pretty vocal about the fact that it's super expensive. And it's a pretty hot market right now. So what they do is they build from the ground up, right? They buy or convert an existing maybe retailer or something and turn it into a self-storage, and that takes a lot of time. And you also have a big headwind from the fact that you're gonna have full operating expenses from day one, and you're gonna have zero revenues because you have to fill the units, right? So their occupancy is much lower than any other competitor, and there's sort of a natural tailwind that as units get to full occupancy, which is usually above 90%, you're going to have a lot of incremental margins. So the self-storage opportunity is definitely not being priced in correctly at the moment. And the other part is the moving business that saw a huge benefits from COVID, obviously, as people decided to move a lot. And we saw this the last 9 months, where, because the same, I guess, the quarter of the current quarter we're in last year was when everything was shut down. So they also suffered. But as things started opening back up, revenues were up 25% or something insane like that. And my belief is that there's an interesting option in when you invest in the stock right now, that the mover rate is going to kick up, which has consistently been coming down. It's around, I think it's 9 or 10%, 2019. I haven't seen 2020 numbers, but if post-COVID we get into a situation where people start moving more, they're going to benefit greatly, and the margins are just going to kick into high gear, and the stock is going to prove to be much cheaper than it actually looks.
Right, that makes sense. One pushback I'd have, or maybe a concern that I've just been thinking about, is, we've seen, at least in the United States, which is where they operate, there's a lot of government push to change transportation to all electric. Do you think that would give them an increase in capital intensity over the next decade that could really hurt their cash generation? Have you thought about that at all, or could that be a benefit because they have?
I actually think it's a benefit, and it's a very good question, and the one that I've heard a lot, as well as the sort of the autonomous question, right, which I think it's much further down the road. But the EV question is certainly very important, and if it does happen, it's not going to be like a 1-year mandate, right? Like these things tend to have, at least 5 years in terms of actually coming to being, into law and being mandated for everyone is my sense. U-Haul turns, I think it's it could be anywhere from 15% plus of their fleet every year. So it's a pretty high number. It's not as high as car rental companies, which are a terrible business for that reason. They have to turn over half of their fleet, but 15% means you can basically switch your fleet completely in 7 years, right? So if that does happen, I think they would be able to do it. They have great relationships with Ford and GM, who are their biggest suppliers on the truck side. And the other benefit that I think would come from being all electric is that repair costs, which are repair and maintenance, which are a huge part of their costs, would probably go down, because the way I understand it, electric vehicles don't need as much repairs as it's less complexity versus an ICE motor, right? So there might be an incremental benefit on that side as well.
Does U-Haul have any other businesses other than the self-storage and transportation?
Yeah, so they actually do, and the company is called Americo, and it's technically a holding company, and it's funny because you were talking about the earnings call, and another criticism they get every single one. Like, you go to the transcripts and take a look, and there's always someone telling them, why don't you change your name to U-Haul? And they're always like, no, we don't care about that. It just gets cut off. But yeah, so they actually have 2 insurance companies, which is a little bit odd. One of them makes sense because it's a property casualty insurance that basically insures the moving and self-storage operation. When you rent a U-Haul and you get insurance, like that's who's underwriting that, right? So that makes some sense. The other one is a life insurance company that they've owned for a long time, and I mean, it's profitable, but there's no synergies between one and the other, and I don't think it's going to go anywhere. Like, the management seems to be okay with it. Within moving, there's a couple interesting things that they also have that maybe is not as obvious, but their retail operation is actually pretty big, right? Like, product and service sales, if you go to U-Haul and buy a box or buy anything related to moving, really, that they're going to sell you in the store, that's a pretty significant part of the business. I think it's around $300 million. They also have a more recent initiative called U-Box, which basically they bring a box to your home as you're moving, and you put all your stuff there, and they'll take it to wherever you want them to move, right? So that's another one that I think has been growing pretty nicely, which I think makes sense to kind of experiment with different business models in moving as well.
All right, I think that's going to wrap it up for U-Haul. We don't want to go too long, so let's hit the wrap-up questions. First one: what is one financial saying you disagree with?
Sure. I mean, there's definitely many, and it's funny because in investing, I always go back to the fact that there's no absolutes in investing, right? So every time you hear sort of a saying in finance, it's always healthy to question it. One that I used to do a lot and kind of learned the hard way that it's not as simple as it sounds is averaging down, right? Like, the traditional value investing school will teach you to sort of double down on a stock when the price drops, 15-30%. And I've learned that you have to, first you have to really think about the reason why it dropped, right? Because in some cases, a very substantial piece of negative news came out, and say the company lost a 30% customer and fell 30%, but maybe it's more expensive because that was their most profitable customer or something like that. So you always have to really consider why the company's stock is down and realize what that means for your investment thesis if it's changed or not. So you have to be kind of really true to yourself in that sense. And I've actually learned to average up more often than averaging down. Spotify is an example. I started buying in the low 100s, and I kept buying all the way to probably around these levels, because when I started buying, it was mostly focused on music, but then they basically doubled their addressable market and executed on podcasting, and the stock price went up, but the opportunity also did. So it's one of those examples where I think it made sense.
I think we're in the same boat there with Spotify, and it seems counterintuitive, and it's easy to anchor to the stock price itself, but I think
just the sales multiple.
I guess
sales have grown at double digits. So
the multiple might even, maybe I'm wrong, but it might be cheaper now than it was at 160 or whatever it was 3 years ago.
Yeah, I can take a look quick, but I don't know if you want to ask the last question.
I'll get to the last one. What's one piece of advice you have for anyone that's starting out in the investing world?
Yeah, so I would say really try to find something that that fascinates you. That's your passion or your hobby, and really try to learn as much in terms of whatever industry or company is related to that. And it's I like to give out the example of skiing, right? I love skiing, and I've been looking at Vail Resorts for a while now, and it's a company that it was so easy for me to study it because I'm so familiar with it, and it's something I love doing. So I think that applies to so many different aspects in investing, and it just makes it a lot more fun, right? And you're going to learn a lot more if you have if you have the interest to do it and really the fascination for it. So I think that's gonna play to anyone's advantage when they're starting out on investing.
All right, that makes sense. I looked at the sales multiple quick. It's slightly higher than it was in 2019, but it's below the IPO. So
yeah, but they've grown with it, right? So yeah.
All right. Well, I think that's going to do it. Where can anyone find you? What's the Substack, Twitter handle?
Yeah. So my Twitter is sleepwellcap, and the Substack is sleepwell.substack.com. So yeah, DMs are open. If you want to chat or have any feedback for any of my tweets or Substack pieces, always happy to get that.
Perfect. All right. Thank you for your time. Enjoyed it.
Yeah, it was very fun, guys. Thanks for having me, and hopefully we'll do it sometime soon.
All right, welcome back in. Thanks again to Sleepwell Capital for joining us. I'm going to kick things off with this week's story. So I titled it Titan to Zero. And
you got a long list here. I'm excited about hearing the story.
It's really complicated, which that should start as a red flag. If these things are super complicated to understand, it's probably not worth investing in them, to be honest. And obviously this one wasn't. But Iron Titanium Token, aka Titan, crashed this week. And I mean crashed. So Titan belongs to Iron Finance, which is one of those, it's partially collateralized and it's a stable coin protocol. So there's all these derivatives off crypto now. And this is basically one of them. And the details of how this thing worked were super complicated, but the aim is basically to reduce the volatility of certain cryptos by linking it to the US dollar and then another quote unquote stable coin. But Be In Crypto, which is sort of, I think it's like a crypto website, explains Titan like this. Iron